This is the Build Wealth Canada podcast, episode number 51.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada show. This is part 2 of our episode on the only 4 ways to invest here in Canada, where we discuss the pros and cons of each method so that you can make an informed decision on the investing type that is best for you. Now, ultimately, this decision on which of the 4 ways you pick has an enormous impact on your net worth and how early you can retire, as it can easily save and earn you an extra tens of thousands of dollars long term, and even hundreds of thousands of dollars for many investors through reduced fees, proper financial advice, and tax optimization that's entailed in some of these choices. So now, in case you missed part 1, you can listen to it by going to buildwealthcanada.ca/50. That's buildwealthcanada.ca/50, just the number 50. Now, after the last episode launched, we had a lot of listeners sign up for the free 30-minute consultation with our expert financial planning guest, John Kalos. Now, one of the links that I had on this site to book the free appointment with John wasn't working, but that has now been fixed. So if you had any trouble signing up for the free call with John, then definitely try again by going to buildwealthcanada.ca/John. That's buildwealthcanada.ca/John. And if you haven't booked a call yet, then definitely feel free to do so, as there's no obligation, it's free, and it's a great way to get some of your financial planning and investing questions answered by someone that has spent decades in this industry and also isn't trying to sell you some high-fee mutual funds or high-fee investment products just because they get some sort of bonus or commission out of it. So, John, he doesn't sell any investments, so he's a great way to get custom advice specific to your situation from someone that doesn't have that conflict of interest from also trying to sell you something. All right. So that link again to book that free 30-minute call with John is buildwealthcanada.ca/John, John. And when you sign up, you also get my PDF guide on how to find the right financial advisor in Canada and the top questions to ask them. Of course, don't miss future episodes, giveaways, and free in-depth guides by also signing up for free to the Build Wealth Canada newsletter over at buildwealthcanada.ca. And lastly, don't forget to claim your free 1-year digital subscription to Canadian Money Saver magazine, Canada's largest personal finance and investing magazine. The magazine features Canada's top experts on personal finance and investing and is a great place to learn best practices and stay up to date on changes that will impact your investments and financial situation for years to come, specifically here in Canada. So to get all that, all you have to do is open up a free savings account with my favorite bank and the bank that I personally use, EQ Bank. And now the reason that I personally use EQ Bank is that they have one of the highest interest savings rates in Canada. In fact, out of all the years that I've been with them, I've seen them consistently be almost double the interest rate compared to other online banks and well over double the interest rate compared to the major brick and mortar banks that we have here in Canada. Plus, it's free to sign up and keep an account with them, so you're not paying a monthly fee like you do with many of the other banks out there. And you get 5 free Interac transfers every month as a bonus too. So because of those reasons, I've been with them ever since they launched in Canada years ago, and it's where I keep my entire emergency fund and spending money as well. So to get the free account and a 1-year free subscription to Canadian Money Saver magazine as a bonus, just go to buildwealthcanada.ca/EQ. That's buildwealthcanada.ca/ the letter E and the letter Q. Open the free account, and once you're done, forward any email that you get from EQ to bonus@buildwealthcanada.ca. And I'll send you a coupon code that gets you a free 1-year subscription to the magazine. So that link again is buildwealthcanada.ca/EQ to open an account. Then forward me any email from EQ to bonus@buildwealthcanada.ca, and I'll email you the free coupon code to the magazine. All right, so enjoy. Thanks for supporting the show in that way. And now let's get into the episode. Let's talk about the Vanguard ETFs a little bit.
Sure.
Just because I've had a bunch of listeners send in questions about them and asking them if they are a good idea, what I think of them, etc. And I'm going to do a dedicated episode specifically for those because there are
some great pros, but there's also some cons. So I, for example, really like them, but I actually wouldn't invest in them myself. And so I think that warrants an explanation. Like, why would you like them and say, hey, I think they're a good fit for some people,
but you wouldn't do it.
But I wouldn't resell, right? So that kind of makes you wonder, right? So I think that warrants an explanation. Now, so just first of all, if anybody wants to look up what we're talking about, specifically which ETFs we're talking about, if you go to vanguardcanada.ca, and then if you go on the top in the navigation bar, it says investments, and you click on that on the drop down, and you select asset allocation ETFs. It's the second one from the bottom on the left. So if you check that out, it's going to show you 3 different ETFs. And these are the ones that John was talking about, where what they are is they are a collection. It's basically a way that you can have a portfolio pretty much where you have stocks from and bonds, from all over the world essentially, and so it's a way that you can have an investment portfolio by just buying one ETF. So I mean, I personally buy 4 ETFs, the same ETFs, but in this one you can only just have one, which makes things a lot easier. Now there are pros and cons to doing that, but it is but I think this is a solution. I think this is something that especially somebody just getting started, if you're just getting into investing, this might actually be, I would consider this as a starting point, because you don't have to worry about rebalancing, because they rebalance for you. And so you can get comfortable buying ETFs and the process and the mechanics of it all, without having to worry about rebalancing. And then after a while, once you feel, okay, I've got a good handle on this, it's not as scary as I thought, everything's fine, then you could ultimately sell them and buy individual ETFs like what I'm doing. And like I said, I'm not saying everyone should do this, based on your situation, right? Like, just because I do it doesn't mean you should do it either. But but I do think these ETFs are a good entry point into into investing. And so the pro is, you don't have to learn how to rebalance yet, which is nice. You're just buying one ETF, which is also nice. Also, what can happen sometimes, I think, from an investor psychology perspective, is that, let's say, you have 4 ETFs, one for Canada, one for US, one for international developed, one for international emerging, right? Like that, at least that's how my portfolio is structured. Well, let's say Canada's having not a great year, like right now, for example, right? It's not, hasn't been doing that great. And so you might look at that and say, oh, well, Canada's not doing so well, but US is on fire. It's been doing great, right? And so the negative, if you're buying the 4, is you might be tempted to say, well, you know what? Let's take some out of Canada and put it in the US, and and kind of, you might start thinking that way. And now, I mean, at that point, you're now kind of speculating, right? Whereas what you should be doing is thinking, okay, I should rebalance, take some money off the table for US, and then put some into Canada to reach the desired asset allocation that I want, right? So that's kind of one thing to keep in mind. The reason so those are the positives of why I think these funds are really good. And John, I'd love to hear your opinion on it after as well. But I just want to address it now because I've been getting these emails quite a bit. Now, the con of it is that, well, one, the fees for them are a little bit higher than if you purchase the ETFs individually, like what I do. Now, they're not much higher, right? But it is a bit higher, and I mean, fees are obviously important. So just keep that in mind. I mean, it's not a crazy deal breaker, but but it's something to consider. But the main reason that I don't do those particular Vanguard funds, like I own a Vanguard, but I own individual ones, right? I don't own like the one ETF where it's my whole portfolio. The big reason is tax efficiency or inefficiency rather. So for example, for tax to be optimal from a tax perspective, you want to have certain types of investments in different types of accounts. So for example, and I'm not going to go into too much detail here because we'll have a whole episode kind of dedicated to it, but I mean, like as a general rule, for example, bonds typically you want to put those in an RRSP. US equities, if you purchase the right type, you want them in an RRSP usually as well, because there's a tax treaty with the dividends where you don't have to pay the withholding tax. Once again, not going to go into detail, but there's tax advantages of doing it that way, right? And if you maxed out your RSP and TFSA, and now you want to put money into your non-registered accounts, your taxable accounts, well, Canadian equities generally make sense because they have preferential tax treatment on the dividends, right? So there are, so like I said, I'm not going to go into too much detail about taxes here, but the bottom line is that there are tax efficiency that you get when you pick and choose to say, okay, like myself, almost all of my US ETFs are in my RRSP because of the preferential tax treatment. A majority of my non-registered is in Canadian equities are non-registered, right? So basically you can break them up to make them very, very tax efficient, right? And so if you purchase an ETF like one of these Vanguard ones, you aren't able to do that, right? Because you're purchasing just one ETF. So for example, you might buy one of them and put that in your TFSA, right? And now because you bought that one, well, that means you automatically are holding a portion of your bonds in your TFSA, which is not optimal typically, right? Right. So that's to me, that's why I really like them. I think they're a great product for someone, or I personally, like if my daughter was getting started investing, I would probably say, hey, you know what? Why don't you consider doing one of these, right? Just to get your feet wet. I think it's good. And then once you get a bit more proficient in all of this, you get comfortable with it, then let's get a little bit more tactical. Let's get a little bit more optimal and save you some money on taxes, right? Kind of a crawl before you walk type of a scenario. All right, so that's my spiel. I just want to address it because I've gotten so many questions about it, and I get too many questions from the show that I literally don't have time to answer every single one. And so I thought, okay, let me just get this out. So thank you for your patience, John. Do you have any thoughts, anything to add, anything at all?
Well, I was about to say, allow me to retort. and so I agree with what you're saying. On the other hand, I'll make a couple of comments. As you mentioned before, the majority of people have a hard time maxing out their RSPs and TFSAs, right? So from a tax point of view, if we don't have a couple of $100,000 and we're dealing with $40,000 or $50,000, there's not a huge difference when it comes to taxes. And I'll say this also, historically, we've said that it's a good idea to keep all your income-producing investments like bonds and GICs in your RSPs, right? And have all your equities and dividend-paying stocks, equities, outside your RSP because of the preferential tax treatment. Well, these days, dividends are higher than interest. So you could be earning income outside your RSP with dividend-paying stocks paying you like a 4% return, right? So, and if your GICs are only paying you 1%, all of a sudden that argument doesn't hold as much weight anymore, right?
Right.
So honestly, I think, as you mentioned, I think it's best for the beginner, do-it-yourself investor, but I still wouldn't close the door for somebody who just says, look, I don't have time. I don't want to be bothered with this too much. I know that if I do this, I'm going to get a very well-balanced portfolio, and all I need to do is look at it, just to see where the value is, and I don't have to make any changes. There are people, obviously, that anything to do with investing is intimidating. And so when you're holding when you're holding 4 or 5 different ETFs and you need to start rebalancing and calculating and, oh my goodness, I don't have time this month. You know what I'm saying? Like sometimes you get caught up. Sometimes the markets move so quickly and you haven't had time to assess and rebalance, that this is an all-in-one solution that's going to save you lots of headaches if this isn't your game. I mean, you enjoy it. I enjoy it. I can do this all day long. But there are, the majority of people are not into this as much as we are, right? So I'm just saying this is a good solution for someone who wants to do it yourself, and is looking for one solution. This doesn't have any negatives from that point of view. And the management fee I'm looking at one where it's 0.22%, as you mentioned, versus 0.1%. It's nothing huge. If we had millions of dollars, I'd be telling you different things. But for somebody who has $10,000, $20,000, $30,000 to invest, what a way to start. This is a great way to start.
Yeah, no, that's a good point. Yeah, that's fair. I mean, when you're right. The benefits of having it broken up into individual ETFs, like what I do. I mean, you really see the benefits of that from the tax efficiency perspective, the management fees, when your portfolio is, on the higher side, right? If you're just getting started and you have, if you're in the tens of thousands of dollars, let's say, then yeah, you bring up a good point. It's not. because a lot of these benefits, it's worth mentioning, right? When we talk about these types of investments and options, a lot of them are based on they're on a percentage basis, right? And so the larger your portfolio is, the more you're going to benefit, right? Like 1% on $100 is just $1, right? Versus on $100,000 or on $1 million is all of a sudden a significant amount. So
exactly.
So you bring up a good point that somebody just getting started too, they don't have a massive portfolio yet because they're just getting started, and so it's not like they're massively missing out on, like they're ridiculously tax inefficient and all that. Like that's not really the case, because and I mean, hopefully. And I guess there's an argument to be said too that by trying to get into the advanced thing right away, maybe that will scare off some people, and now they're not investing at all, or they put it on the back burner. They say, okay, I'll get to this later. You know what I mean? Whereas, and then they never get to it, or they don't get to it until 5 years from now. Whereas if they did the other solution, which is easier, maybe not as optimal from a tax efficiency perspective, but easier, they would have been invested those whole 5 years, and they would have been way further ahead, right? So
very good point. Very good point.
Yeah. So, John, you mentioned the piece about the interest rates. How I mean, in some cases, right, with how low the interest rates have been versus what, how high dividends can be with certain companies. So, I mean, what's your thought process there in terms of, I mean, where do you keep, when you talk to your clients, where do you tell them to keep their bonds?
Well, look, it'll depend on what the goals are of a client, right? If a client has a goal that they're saving money to buy a home 2 years from now or 3 years from now, typically I'll tell them you need safer investments because anything can happen in the markets over 1 or 2 years. So by need, they'd have to keep conservative investments outside their RSPs.
Yes.
And so that's how I would advise on that side. But it definitely, something, Cornell, I don't have a written rule right now that says fixed income should be here and growth stocks and stuff like that should be there. If you're buying growth stocks that don't pay dividends, so you're not buying the big companies and you're looking for capital gains, then you keep that outside of your RSP. But if you're someone typical that, wants something relatively safe and, that has a good track record and they're very well-known companies like Bell or banks or stuff like that, they're paying 4% on a return right now. So I'm questioning whether I should keep that type of investment outside, especially if I don't need the income. I'm questioning if I should keep that inside my RSP or outside my RSP. I don't have any clear-cut. There's no clear-cut solution or clear-cut reason that says do it one way or do it another. I will look at the individual needs of the client, and when it sounds like an easy way out, but we need to look at the individual needs, the individual income needs of a client. What their tax situation is all about as well. So you can't just say buy this dividend-paying stock outside your RSP because you're going to save on taxes. Well, what if a client is already in a low tax bracket? I have a client, for example, right now who makes a lot of money. This year, they're not making any money because they decided to live off the money that they had saved outside their RSP. There was they received a windfall of an income, something like an inheritance or so. And I suggested to them not even take it's a business owner. And we said, don't even take a salary this year. So in this case, I mean, I'm telling them, take money out of your RSP this year. Right. So the point I'm trying to make is that every situation is so different that you really need a specific solution these days and not have, as we mentioned earlier, these rules of thumbs of do this if this is happening or do that if that is happening. It really comes down to individual situations, individual income, tax brackets and where they are at and so on and so forth. Those are the things that, and this is where, Cornell, and you've gone through the experience. This is where financial planning comes into play. We've talked about these three situations or these three choices. We have one more to talk about. I got to remind you because we're going into an hour, but we have one more choice that people can do how they invest their money. But it boils down to this. You need to before choosing a Vanguard or an ETF or a mutual fund or a broker or 500 shares of Bell, you need to do a financial plan that will explain you what the choices are, why we see these choices, what the pros and cons are before you make any kind of investment decision. I just wanted to back up and put that point out in front, because really we can't say take this solution if we don't have a financial plan guiding us as to what needs to be done.
For sure.
So let's just we're getting ahead of ourselves. Let's just make sure that people understand that we shouldn't be making investment decisions based on the returns of something or based on that it's cheap or anything like that. We really need to do a financial planning process first, which will guide us as to what solutions are best.
For sure. And I mean, the way that I look at this podcast, right, is when we say these sort of general statements, it's a starting point to get you thinking about it. And then the next step is to see, okay, how does this apply to my situation now, based on all the things that could impact whether I should do X or whether I should do Y.
Right.
Yeah.
Absolutely, and and again, I say this: you've gone through this, and when we did your financial plan, and if there are any people that I've spoken to in the past that are listening to the show right now, this is pretty much what I've always said, and it's something that's not followed as much as it should be, and I'll blame the industry when it comes to that, because the industry is sort of biased towards sell products so we could make money, because that's how most people get paid. And so sometimes the financial planning aspect is left behind, and we sell products based on return and based on what's the hottest thing right now. So it's not going to work. And if you're really serious about your money, that's not the way to go.
Mm-hmm. Gotcha. I'll mention one thing too, because we were talking about just to go back about the whole bonds and where they should go, that kind of piece. I'll tell you what I do, and just to get your thoughts on it, to see if, or I'll tell you what my logic was at least, because it'll be interesting to hear if you agree, disagree, or if you would tweak that in any sort of way. So I mean, typically the way I've thought about it, when it comes to the bonds, is I would say yes, I would keep them in my RRSP, because one, I wouldn't want to keep them in my TFSA, because typically I want the assets that are going to grow the most in my TFSA, because if something's in your TFSA, it's fully tax exempt. And Correct. So obviously if something's going to go up a lot, I want that to be tax exempt, not the thing that's going to go up a little bit, which historically, obviously, equities have outperformed bonds. So that's why I haven't ever put bonds in a TFSA. And then in terms of and if it is, okay, do I put them in a non-registered account versus RRSP? Then once again, I'll say I've always had the preference of, I would rather put the bonds in an RRSP, because if I do have everything maxed out in my RSP and TFSA, and I have to start putting money into the non-registered account, I would rather have my Canadian equities in there, because they do have more preferential tax treatment. From that perspective, because of the tax credit, right? Right. And I can control if I want to sell them off or not. So whether I want to incur the capital gains or not, right? And get taxed on those. Right. So it kind of gives me a lot of control. Whereas if I hold a bond in there, well, that's just going to be spitting off interest basically, right? And that's going to get tacked onto my income, and I don't really have much control over that, right? So that was my logic for, okay, I like having them in the RRSP instead, because I have a lot more control that way. You know what I mean? Right.
No, that makes sense, and it comes back to the point that I made, where if you're buying growth stocks, then you keep them outside of your RSP. That's where the decision becomes a little bit more difficult, is if you have $10,000 that you want to buy either a GIC or you want to put into your RSP or outside your RSP, and your choices is basically the income that's being made. I want to earn an income, for example, and I want something safe. So it's either going to be a bond or it's going to be a dividend-paying stock. Well, if the dividend-paying stock is bought outside your RSP and it's going to increase your income and you're already at the highest tax bracket, then I'd think a little bit about making that decision. But if you're basically investing with growth over the long term, then I would obviously keep the money or keep the investment outside my RSP. It just comes to the point where there could be investments that'll increase your income more than others, and so you're going to be taxed more. And about the preferential tax treatment on dividend income, yes, but when we're earning 4%. On a dividend-paying stock, and GICs were only paying 1% just a couple of years ago or a year ago. Maybe they're a little higher right now. There were situations where I told people, "Hey, your income is going to go up if you if you keep the dividend-paying stock outside your RSP and keep your, bonds or GICs."
Right, understood.
So that's where the decision becomes a little bit more delicate, let's say. But again, you're looking at growth stocks that are not paying, or they're paying very little dividends, then definitely keep them, as you mentioned, best in your TFSA.
Right. And what's your logic for keeping high growth, low dividend stocks outside the RRSP? What's your reasoning for that one?
Sorry, you said high growth, low paying dividend stocks?
Yeah, so yeah, stocks. So like the US index, for example, right, where the dividends aren't very high relative to Canada, for example, but they have historically have had much higher growth. So more capital gains, less dividends. So you mentioned those ones, stocks of that nature, or stocks that are just pure growth and don't issue any dividends if you're buying individual stocks. You said you would, as a kind of generally speaking, you like to keep those outside the RSP. Are you saying because you'd rather put them in the TFSA instead, or what's your reasoning there?
Growth stocks, again, going into a TFSA for the same reason that you mentioned, that there's a preferential tax treatment when you have money in a TFSA, so you can sell without having any capital gains, right?
Right.
So hands down, growth stocks in my TFSA.
Gotcha. Okay.
It's simply, again, there's zero tax consequences.
Gotcha. Okay, sounds good. Yeah, I just want to make sure I understood what you were saying there, because the audio cut off a little bit, so I wasn't sure. But okay, no, that makes total sense. Right. All right, so yeah, we're at over an hour now. Let's get to the last point. Maybe I'll stop trying to. I'll stop with the back and forth.
Don't stop. I think people are getting value out of our discussion.
I think it's a really good conversation. I don't know. I'm I'm biased because I'm in it, but I do think the things that we're kind of sidetracking to are still very important and relevant things around this that people should know. No matter what. And you know what, just as a quick thing too, we mentioned those Vanguard ETFs. I'll give people the tickers in case they want to research them as well, because I have a feeling I'm going to get questions about that. So VGRO is one of them, VGRO, VCNS is the other one, and VBAL is the third one. So those are so I told you before how to get there on the Vanguard site. But those are the tickers I just gave you, or if you want to kind of research it more. And like I said, I'm not saying buy these. I'm not I'm not trying to sell investments here. I'm not, your financial advisor or planner or anything like that. These are just things that, like I said, John and I thought are probably worth considering, especially if you're just getting started or have a smaller portfolio, as they're an easy entry point and the fees are really, really low. Would that be fair to say, John?
Absolutely. Okay. And I'll say this though, if you are a beginner and you're listening to this podcast and we're telling you that this is a pretty good solution, I would say don't buy it until you understand it. Because if you're saying to yourself right now, man, I don't know what they're talking about, but it sounds good, and I'm not sure what they mean, that's very scary, because the markets will go down, and when they go down, you're going to be asking all sorts of questions. So make sure you understand. Listen to the podcast several times. Make sure you understand what it is that you're buying. Or, we're giving you these 4 choices right now. Make sure that you understand what each of the choices are all about. We may have used some. We try to keep it simple, Cornell, but we may have used some jargon that people are saying, what's this all about? Especially people that are not, this isn't their. It's easy for us to talk about this, but some people, this is a different language, right? So make sure you understand anything before you get into. And I think that's a good way to lead into the 4th choice that people have. And I'll very quickly recap. Choice number 1 was having a financial planner, an advisor that's using managed products like mutual funds to invest your money. Having an advisor who only uses individual stocks and bonds. The third one was being a do-it-yourselfer, and you're out there doing buying everything, and we recommend exchange-traded funds when it comes to that choice. The 4th choice is to use the exchange-traded funds, which are the cheapest way of getting your money into investments, but having an advisor guide you on that. And that's a choice that wasn't available just a few years ago, again, because typically when you're using an advisor, and the pros about using an advisor go back to what I mentioned a little earlier, and basically it's to keep people real and to help people from doing irrational things. That's one reason. Choosing a right asset allocation based on your goals is another reason why it's important to have a financial advisor if you're not able to do these things by yourself. But if you can find a financial advisor who is not using managed money and are using ETFs basically to invest your money, well, that's a pretty good solution if you feel like you can't do it on your own. But as I mentioned, the pros of that is you are getting advice and you're paying a lot less than what you would pay if you're dealing with a typical investment advisor that's using, mutual funds. Now, the con about that is that they're very hard to find. There's not, but it is an area that's growing, but let's face it, 95% of financial planners, investment advisors are working either for banks or affiliated companies of banks or independent firms that make their money selling mutual funds and stuff like that. There's not too many in the area of I'm a financial planner, I'm doing unbiased financial planning for clients that has nothing to do with products, and then that financial planner is able to guide you with ETFs as well. That's the fourth solution that's available out there, and I've said it before. This is what I use with my clients. I rarely look at any other solutions, and people that have heard me on your show, I've spoken to some of your listeners, and they already come in with the idea saying, yeah, we know that you do ETFs, so tell me what you can do for me. So that's pretty much the model that I like to have. And it's not accessible. I mean, I shouldn't say it's not accessible. It's hard to find someone like that. But there are a few advisors out there in Canada that are doing that. And you can find it. If you dig a little bit, you can find them, that's for sure. But it's not very typical right now, and that's not going to be the everyday experience you're going to have if you're dealing with a typical financial advisor.
Right. Yeah. Because typically, correct me if I'm wrong, but you're the one that you used to work in that banking industry, right? My understanding is the most common way is that someone, you go to your bank and you say, hey, I would like to start investing in my RSP or ESP or TFSA, whatever the case may be. And then you're presented a menu of options. You get a very quick, I won't call it a financial plan. They may call it a financial plan, but it's like a quick little questionnaire type of scenario, right? And then it's all about getting you investing as soon as possible and buying investment products. It's not a comprehensive financial plan that talks about everything and looks at your tax situation and goes for tax efficiency and all of that, right? And factors all of that in. So I think you're kind of part of the new sort of this new era, right? Where it's okay, let's take things a bit deeper because investments are only a small portion of the whole picture, actually.
Right, an important portion, obviously, but also small. But it's the one area where people get very emotional about because they don't want to see their money going down, right?
Right.
But typically, as you mentioned, I'll say it like this: if you're a beginner and you walk into a bank, you're not going to see a financial planner. They don't want to see you because you don't have money. Let's face it. If you don't have a couple of $100,000 and you walk into a bank, you're not going to meet a financial planner. They're not going to introduce you to a financial planner. They're going to introduce you to a banker who, as you mentioned, has like a preset questionnaire that they'll ask 7 or 8 questions, and then they'll fit you into a portfolio of mutual funds. If you do have a couple of $100,000, they'll introduce you to a financial planner who gets paid based on the products that they sell. So again, being in the industry for such a long time, and it's been close to 4 years now that I've been on my own, but being in the industry since the mid 90s up until 2014 or so, this is how the model works. And I get, not to say that all advisors, all they do is look look out for what's in their, we know what'll end up in their pocket. But there is an inherent conflict of interest when you're being advised by someone who gets paid based on the product that they sell. Bankers have objectives to sell GICs and they have objectives to sell mutual funds. If they're at 140% of their objectives in GICs and they're at 60% at the on the mutual fund side, the manager is breathing down their neck every day, saying, "What about the mutual funds? When are you going to increase your sales?" So I'm not even blaming the individual advisors. This is just how the system works. The banking system works. It's profits first, and I hate to say it. I mean, it sounds so negative, but that's what it is. It is what it is, and we have to be very careful as to how we are, who we are letting our money being managed by. Who's managing our money? We need to be careful about that. Mm-hmm. And I can't say that enough. Only because I've seen, I've seen it all over 25 years, and so I had, I was losing sleep at a point when I was in the industry, and so that's one of the main reasons why I left. Because anyhow, again, I'm sort of getting off on a tangent here, but these are, I can't stress enough about how cautious you have to be when it comes to this.
So were you losing sleep because your job is back when you did work at the kind of traditional bank, because your job was to push these products and push the products that you're being told to push, whereas you might know that, okay, I know this client, I know their situation, I should really be suggesting this. We should not be gouging them on fees like this, but you have no control over that because you're just an employee that's part of the larger machine, and your hands are tied in a lot of ways, and so that's why you went on your own eventually. Would that be fair? Is that accurate?
Well, yeah, to a degree.
Yeah.
I was forced to push funds early, or to push investments early in my career when I was a stockbroker, and I was told that I have to sell, a new issue, a new company going public, and our firm was taking it public, and I had to sell these shares to my clients, and I wasn't very comfortable about that. But when I went into the banking industry in the mid-90s, back then, you were able to give advice based on what the client needs. There wasn't too many sales objectives, but you still had to sell the products of the firm, of the bank that you were working with. But what I did, I've been an ETF guy before the term existed. I used to recommend something called index funds, which are still out there. Back in the 90s, when again nobody knew about them, but banks had started to make them available to their clients, and I was selling clients index funds for their needs until I was told by the first bank that I was working at, until I was told you can't do that anymore. Sell the managed funds and let the do-it-yourselfers buy the index funds. And I said that's not happening, and I left and I went to another bank, and they let me do that for the other bank let me do that for 5 or 6 years. And then I got the same, speech after, and so I left from there and I went to the private banking division of one of the banks, and well, we weren't selling mutual funds there, so I was pretty comfortable, and that's where I really learned about true financial planning, other than just investments. Tax planning, estate planning, mortgage planning. There's a whole bunch of things that are associated with real financial planning. And at that point, well, a few years ago, I said, "Hey, I can do this. I can offer the same professional services that a private bank offers, but at half the cost." So that's what really got me excited, and I went out on my own, and the rest is history. But no, I can't say there was only one time in my career where I felt pushed to sell investments, and that's when I was a stockbroker in the mid-90s, and I had to sell individual stocks that were very they were very risky stocks to my client base, which was quite conservative. So that's why I left in the mid-90s and I went to the banking side. So there I was left to do what I wanted to until they told me not to, and then I got up and I left, and there you go.
Yeah. Well, because I guess what you were suggesting wasn't making them enough money, right? So they didn't like that piece.
Exactly. They were, index funds were charging, I think, 0.9% back then, versus the traditional funds, which were 2.5%.
So you chose the client's interest over the company's interest, basically.
That's right.
And that didn't sit well with them. Yeah.
until they caught on. It took them a while, but they caught on.
Yeah.
Nobody was really monitoring that. All they wanted to see is how much mutual fund sales people were making. And index funds were considered mutual funds. So they all went under the same line. But then they got a little bit more specific, and they were looking at the fine lines, and they were saying, this guy's not producing as much income for us as the other guys are. So,
Right. So when you talked about index funds, are you referring back then, are you talking about things like TDE series, Tangerine, those kinds of, where
That's right.
it's technically a mutual fund, but it's like a passive mutual fund that holds the index?
Yeah, and all banks offer them. CIBC, I believe, was the first one that offered them in the 90s. Maybe I shouldn't be naming names, but no, CIBC was offering them. And then I went to Bank of Montreal, and they were offering them as well. So, and again, back then you were able to give advice or sell products based on the client's needs. You had to sell the bank's products, but at least it wasn't, I wasn't meeting Mrs. Smith, 75 years old, and I was forced to sell mutual funds to her because my, numbers are not as high as they should be.
Right.
So that was, and I can tell you one thing you'll notice if you're dealing at a bank, or if you're dealing with a broker or an advisor at a bank, it's a revolving door, and you're going to get someone new almost on an annual basis, because they come in, they get chewed up, and they get spat out. Like and clients would always say at banks, how long are you going to be here for? You want to manage my money, and chances are 2 years from now you're not going to be here anymore.
Right.
And that's what people are faced with when they're dealing with bankers, and that's what people are starting to realize, and that's why my corner of the industry right now is growing quite rapidly. People realize that the investors' needs are not being met 100%, and so that's one reason why we're starting to see more players leaving the institutions and pretty much doing what I'm doing.
All right, John, I think that's a great place to end it. Now, for anybody not familiar with you or wants to know a bit more about you, can you tell us a little bit more about yourself, your practice, what you do?
I'm a certified financial planner, and I have been since the late 90s. And in the past, I've worked for the big boxes, the big banks, and their affiliates. And then about 4 years ago, I went out on my own as an independent financial planner. And so the services that I offer is typically I help people with financial planning, meaning we create a financial plan, and then we're able to implement the plan as well for our clients. I think the best way to describe it is to give you an idea of what some of your listeners went through when they reached out to me. So basically, we offer a consultation, a free half-hour consultation for your listeners. And typically, what happens in the calls is, they sort of tell me, well, here's a situation that I'm in, and here's the reason why I called. And I basically explained to them what financial planning is all about and what are the aspects that should be looked at. And then, if people want to go in a little bit deeper, then I ask them to fill out a certain questionnaire that I offer, and then we take it from there. But I think I've been told that people have gotten some very good value just from a half-hour conversation that we have, and it's I've been very impressed with how many people have actually called up or sent me an email, and they're able to do that from your site, if I'm not mistaken. And so that's it. I think it's a good way to start is to have a little conversation about what's eating you, what's on your mind about your affairs, and it seems like people have gotten a lot of value out of that. So I'm very happy about that.
For sure. Yeah, we've had a lot of people sign up. And yeah, if you are interested in speaking with John, go to buildwealthcanada.ca/John. It's totally free. There's no obligation or anything like that. It's just a free kind of 30-minute consultation. And I'm sure you'll get some questions answered, and you'll also see if maybe you want to work further with John or not. But either way, I'm sure you're going to get lots of value out of it, and and at the very least get some questions answered for free. So it's just buildwealthcanada.ca/John. And yeah, at the very least, you'll learn a ton. So enjoy that, and thank you very much, John, for offering that to Build Wealth Canada listeners. I know your time's very valuable. You're a very experienced financial planner, so it's great that you offer that service.
You bet, Cornell. It's my pleasure.
Okay, so have a great one, and we'll see you on a future episode. We'll definitely have you back.
You bet.
All right, take care. Bye.
Thanks a lot. Bye.
All right, thanks for tuning in. If you do have some questions for John, or if you'd like to discuss potentially having him take a look at your financial situation too, just like he did with my family, then you can sign up for a free consultation with him by going to buildwealthcanada.ca/John. It's totally free and there's no obligation or anything like that. And I mean, worst case scenario, you'll get a bunch of your investing and financial planning questions answered, specifically customized for your particular situation. Also, don't forget to get that free 1-year subscription to Canadian Money Saver magazine and double that interest rate that you're currently getting in your checking and savings account by signing up for free to my favorite bank that I've been using for years over at buildwealthcanada.ca/EQ. That's just the letter E and the letter Q. Once you do that, forward me any email that EQ sends you over to bonus@buildwealthcanada.ca, and I'll send you the coupon code that gets you a 1-year free subscription to Canadian Money Saver magazine. So that link again is buildwealthcanada.ca/EQ. Open an account and send me any sort of confirmation email you get from them to bonus@buildwealthcanada.ca, and I'll send you that coupon code to get the free magazine subscription. All right. You'll also get that extra perk of 5 free Interac e-transfers every month, and you'll know that you're getting one of, if not the highest interest rate in Canada on your savings account. All right. So that's all for now. Have a wonderful and safe winter season, and talk to you soon.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.